Ladies and gentlemen, thank you for attending our presentation tonight. I'm Dr. Masaki Oishi, Chairman of Market Space Capital, and it is my honor to have you as our guest tonight. Today, we would really request that you put aside any expectations. We are not trying to sell you anything. We are not, we're not trying to pitch anything. We do not offer advice as a product. We are genuinely interested in sharing our opinion and point of view as to where we are in terms of the real estate market. And we would genuinely appreciate your input as investors as to where you think we are in terms of the market itself and where we should be as far as moving forward on the roadmap to the future. As I was driving into work today, I was listening to the radio, and it occurred to me that there is so much conflict and strife going on in just about every corner of the world. I feel so thankful that we are all living in a place where we have relative stability and safety for ourselves and for our family. And it is with this sense of thankfulness and gratitude that I would like to greet everybody attending today's presentation. When I first started Market Space Capital back in 2016 or 17, it was just me and one other guy chasing deals. And it was not an ideal situation, but it was what it was. When our third partner, Sohail Hassan, joined us in 2017 or so, I think that's when everything started to change. We developed a more corporate culture and a strategic vision for the future of Market Space Capital. Sohail has been instrumental in bringing corporate culture to our organization and also bringing his business acumen in terms of bringing our company to the forefront in terms of real estate in Houston, Texas. Very recently, Sohail has been recognized by the Houston Business Journal as one of the 40 most influential businessmen in Houston under the age of 40. He's finally getting the recognition that he really deserves. Being under 40 used to mean something to me, but now, being as old as I am, not so much. In any case, I would like to introduce my very good friend and a very good partner, Sohail Hassan. Some of you may know him, some of you may not, but he has been at the forefront of our company's expansion and future projects and strategic thinking. Very much worthy of the award he received from the Houston Business Journal. Please welcome Sohail Hassan.
Thank you, appreciate it. Thank you so much. Thank you, Dr. Oishi, and in particular, thank you for your trust, your support, and more importantly, your leadership. So if everyone could please give a round of applause to our chairman, Dr. Masaki Oishi. I know there's some familiar faces here tonight, so thank you for coming, but there's also some new faces. So please allow me to take the liberty of talking a little bit about Market Space Capital and what we've built today, and of course, where we see ourselves going in the future. And of course, we're joined this evening by our other partners, our managing partners. Of course, we have Mr. David Rodarte in the back room over here. He oversees our construction and renovation side of the business. And then, of course, you just heard from Dr. Masaki Oishi, who serves as our chairman. And I'll tell you, these two gentlemen have been doing investments together since about 2011. I was introduced to them in 2016, 2017 timeframe. And really, I could see from their business acumen and their experience in real estate investments that they had something. And it was just a matter of joining and organizing ourselves and building a team. And ultimately, that's what we've done today, and our success is attributed to that. But nevertheless, Dr. Oishi here is actually, and some of you may not know, he's kind of famous. He's the author of a book called Prescribing Real Estate, and it's a physician's guide to investing in real estate. And ultimately, that's really how we've cultivated a investor network that's primarily made up of high net worth physicians from across the country. It's because he sees the advantages of investing in real estate, and ultimately that's why we got into this, right? First and foremost, we understand that investments in real estate allow for risk-adjusted returns, right? It doesn't have the volatility that is inherently applicable to investments in stocks, for example. Real estate is a tried and true asset class, something you can touch and feel. And for that reason, we have long made sustained investments into real estate that can provide consistent returns, right? Furthermore, we basically have creating ourselves different passive income streams. That is one of the benefits of investing in real estate, is the idea that you're creating long-term income streams that obviously are beneficial to not only the investors, but to the community as well. And then, of course, perhaps one of the biggest benefits of investing in multifamily real estate in particular is the tax advantages. And this is something that's not applicable in single family residences. Specifically, this is called cost segregation. It allows us to basically depreciate an asset, 30-year life cycle of an asset, into different tax categories. And by doing so, we can pass on that depreciation to our investors. And this is perhaps one of the most attractive reasons why people invest in real estate. In addition to that, after you exit a sale, you have the ability to do what is known as a 1031 exchange, which basically allows you to avoid paying capital gains on those investments. So if done wisely, real estate is a way to generate long-term wealth. And that's really the reason why we were attracted to this particular business. And of course, the final reason is because it's a hedge against inflation, right? As of course, this is something that we're living and breathing today. And you can imagine that we have the ability to adjust rents as needed, right? So it really is the best indicator in terms of economic cycles, as well as being able to hedge against any risk in a market. So when it comes to market-based capital, what we really pride ourselves on is taking a data-driven approach to investing in real estate. So first and foremost, we've created an econometric model. Really, it's just a fancy way of saying that we collect about 27 different pieces of data. And that data really goes into our decision-making process, right? Now, part of this is selfish, right? We don't want to spend unnecessary time, money, and resources on a project that doesn't fit those parameters. So by being able to identify those parameters immediately, we can check off if a project kind of meets our investment parameters. Secondly, we, of course, use financial model and underwriting. Now, it's very important to know that in all of our underwriting analysis, we use kind of a base case scenario, right? Then there's a worst case scenario that takes into consideration stress tests, like what's happening in today's market where interest rates have risen rapidly. The other part of this, of course, is the best case scenario, right? Ultimately, what we want to do is be very conservative in our underwriting to kind of underpromise and over-deliver to our investors. Of course, then is using technology everywhere that we possibly can. So this starts with from the very beginning, understanding if a project meets our investment parameters and we move forward with an investment. The very first thing we do is send a team to these sites to conduct a lease audit. A part of that lease audit is going unit by unit and checking the conditions of the property, right? Now, all of that is going into a software, and we can basically attribute certain values to the unit. So if it's a unit that needs a lot of work, maybe $10,000. If it's a unit that needs lighter renovations, maybe $5,000. But ultimately, that's how we can back into what our total renovation costs would look like, simply by using software, right? So using technology to be able to drive our decisions. And then those that require the least amount of investments, we of course would look to target those first in order to renovate and put back out onto the market. So ultimately, we're using technology not only for our site inspection, but also for managing our investors. As many of you in this room who are investors with us already know, we basically have invested in an investor portal that allows you to log into our system and access updates to, quarterly updates, the tax documents, all directly, of course, available 24/7. But let's get into a little bit about what we've built today with markets-based capital and kind of the three different verticals that we've identified for our company. The first vertical is what we call our value add investments. And our investment thesis is quite simple. We're investing in Class C to B conversions. So imagine we're buying in at a cost basis around $70,000 to $85,000 per door. And most of these are assets that have issues, right? They have occupancy that shows 90%, but their economic occupancy, how many people are actually paying rent, are usually around 50, 60%. Right? So when we acquire these assets, we know that the very first thing to do is identify the non-paying tenants. Now, some of them are on hard times. We work out payment plans. About 20% of them are simply trying to scam the system. They go apartment to apartment, and they get a unit there. They stay as long as they possibly can until they're evicted. Right? So as we evict those tenants, of course, those are the units that we focus on first, depending on the condition that they're at. Right? But it's quite simple. We come into areas, in some areas, like you see the two apartment complexes here. These are Main Ridge and West Ridge apartments. They're 520 units, and they're located in NRG area of Houston. When I say NRG area, if you exit Kirby off of 610, you go straight, you see NRG Stadium on your right, you hit a light called West Ridge. If you make a left on that light, there's a bunch of Class C apartment complexes. And honestly, at one point in time, it's probably a place that you don't want to go after 8 p.m., right? But this area was hit with hard times. The asset was built in the late 70s. The owner was, not investing any money into actually renovations, and it had, the very low income with a lot of crime. In fact, if you look at a heat map of Houston, of looking at specifically the crime, the heat map would dead center red right when you would come to this area. Right? And so we acquired these 520 units. We bought them for $85,000 a unit, right? And once we have finished the acquisition, it took us about 12 to 14 months to finish our complete business plan. And what that includes is, the first part about it is crime eradication. Now, some of our assets were really blessed. We don't have to deal with any of that. But I'll tell you, the ones that have those issues, that's really where the value add is. And understand, people, that we're not just doing this for our own sake, for investments, but we're literally spending millions of dollars to revitalize these communities. And that's where the opportunity for us and our investors lie. Right? So in the same way, you can see Main Ridge and West Ridge apartments. I mean, literally 3 months after we bought the apartment, there was a shooting. Someone was murdered on site. Right? We came in and we implemented a security gate system. A scanner to scan everybody's license plates coming on. Immediately, it made like 100% impact on crime at the property, right? Since then, we haven't had any single incidences. We've renovated now all of the units, all 520 units. When we typically buy these assets, since these are Class C assets, we're not getting the most competitive debt terms. So we're used to paying higher interest rates. So for example, on this property, we paid 8.99% interest rate, right? Within 24 months, at month 18, we refinanced because we had completed our business plan. We had evicted all of the non-paying tenants. We renovated the units, and then we filled it back up with good paying tenants. And honestly, in that area, most of them are related to the Texas Medical Center, right? And in a moment, I'm going to get into, we started heavily investing in the NRG area back in 2018, and we actually own 2 other assets there that we exited out of already. And in a moment, I'll walk you through kind of a case study of what that looks like. But here, we have been, again, we bought these assets for $85,000 a unit. Now we believe our exit should be right around $130 to $135 per unit. That is what our expected exit price is. Now we've completed the renovation plan, and exactly at month 18, we went and we refinanced. We took it down from an 8.99% interest rate to a fixed 5.284% interest rate. Right? So now immediately we did a large cash out distribution to the investors. And now the investors are receiving on a quarterly basis a 2% return. So an 8% annual cash on cash return. Right? And now we continue. Now, if at the height of the cycle, we were getting LOIs. People wanted to buy this from us for $120,000, $125,000 a door. But we know what it's worth, $130 minimum, right? We were seeking $135. So what do? We just wait, and we continue to cash flow the asset, and we do distributions to investors. Now, these are 2 other assets that we own in the Greens Point area of Houston. And this is called the Huntington and Excelsior Apartments. They're two neighboring apartments right across the street from each other, totaling 464 units. So Excelsior Apartment is a great apartment complex, has 200 units in excellent shape. Huntington was the problem across the street. So once again, we came in and we're now about to finish. We're 20 units, 30 units away from completing the renovations and are in the process about to refinance these assets. So with all of them, the idea is, again, we know going in that we're not going to be receiving the most competitive debt rates, but once we've had an opportunity to implement our business plan, then we basically can go after more competitive rates, which allows us to give out distributions to investors and then, basically cash flow the asset. So today we sit with about 2,400 units in our entire portfolio from Houston to Dallas, almost entirely vertically integrated. We have our own construction, renovation crews, slowly are now transitioning to take over property management ourselves. And, those 2,400 units represent about $365 million of assets under management. So in 2020, we started getting into the ground up development side of the business. And, I always like to say this is the natural evolution of a private equity real estate firm, right? You kind of start out with your own money, the partners working. Once that goes well, we start opening it up to friends and family. At some point, you get sophisticated enough to where you start getting into other different lines of business, as well as attracting institutional capital. And so in 2020, we started looking at actually getting into the construction side of the project. And our first project is the Spot at Anderson. And this is a 155 unit garden style multifamily apartment complex located in Southwest Houston. And, this, once again, the data drove us to this specific model, which we call the attainable housing model. And now the idea is that it has the higher end finishes. It has the granite countertops, the stainless steel appliances, but it's more amenity light. Right? And our cost per square foot in terms of what our rent is much lower than the brand new product that's out on the market. Much of that stuff is $2 and north per square foot. We're starting at $1.60 per square foot. So the idea is that we're really targeting middle class America, right? That's who we're targeting through this. And really, we're now 60 to 75 days away from completing construction on this project. Our goal is to lease up about 20 to 25% of the project before it's even open. And once it's open, we stabilize, we basically, refinance and cash flow, or we exit, right? We're already talking to other investors who are interested in essentially acquiring it from us. So that is essentially the business model here. And we believe that, this is something that we can replicate in tertiary markets around Houston, Dallas, Austin, where we can build at a low cost around $150,000 to $155,000 per unit. And we can exit around $185,000 per unit. And, we have the ability to build these and to fill them up very quickly. Our next project is the Spot at Myra Park. This is a 5-story wrap. I'll tell you, in 2019, we started spending a lot of time in Dallas, right? And basically, once again, the data led us to the market of Dallas, understanding that DFW makes up the 6th largest economy in the country. Right, and seeing that the exponential growth in the market. So we started spending some time there, hired some employees, opened up an office, and ultimately we came across a site that we fell in love with. And I believe David and I visited the site and we started doing diligence in December of 2019. By May of 2020, we ended up acquiring the site. The site is 6.3 acres and it's located directly adjacent to the Dallas Medical Center. And when I say adjacent, it literally used to be a parking lot for the medical center. We acquired it from the owners of the hospital, which is a REIT that is based out of Los Angeles. So we came in and we acquired the site from them. And once again, looking at the data, we saw that there's a huge gap there for assisted living. And when I say assisted living, I mean active adult living, which is specifically 55 and up, or as we refer to as age restricted. And looking at the population dynamics of the Farmers Branch area, if any of you know Dallas, about 3 exits away from Dallas Galleria. So we broke ground on this project in late 2021. We have a construction timeline of end of next year. But this is a 250 unit, 5-story wrap. And this is a luxury style swimming pool in it. I mean, when I told you about $150,000 to $155,000 per door for our garden style in Houston, this one in Dallas is $272,000 per door. So it's about a $67 million construction project. right? But you can imagine this one is a podium style parking garage. So it has a parking garage, and that's really what makes up a significant component of the budget, as you may know. So this is another one that we're very excited about, and once again, construction is currently underway. Our final project is the one you can see here at the top, which is called the Reserve at Hickory Creek. And this is a beautiful piece of land that we acquired. It's in an area called Hickory Creek, about 25 minutes north of Dallas. And this 19-acre site already had a 17,000 square foot mansion that was on it. Our initial idea was to keep the mansion there and build 210 single family townhomes for rent that we would do there. And if any of you follow the real estate market, this is perhaps one of the hottest products right now in real estate, specifically because interest rates are so high. So products where for rent products have become very much in demand, specifically by institutional capital. And so we bought this site, and then of course, as we were going through the design of it, we were approached by a very large home builder that basically came and put it under contract. So we are now under contract to sell this particular site, and we are doing the horizontal development. So each of these single lots are essentially what we're selling off to this developer. And you can imagine they're buying them from us at $92,000 a lot times 225. You're looking at an exit price of $20.7 million, right? And so very simple. And this group is now making a big, they're spending a lot of resources into setting up offices in Texas and specifically in Dallas. And so this is a project that we certainly see us being able to do repeat business with. So with that being said, this makes up our ground up development side of our business, these specific 3 projects, which currently represent about $150 million of projects that are currently in various stages of completion or construction. And then the final vertical of our business is what we call the mixed use development, right? And this is really made up of one enormous project, and that is for the repurposing of the former Tri-County Mall in Cincinnati, Ohio. And yes, ladies and gentlemen, I said a former shopping mall. And, the idea these days is that these shopping malls are really being converted not only to these mixed use developments, but really into micro cities, right? And as you can imagine, this mall is suffering the fate as a lot of shopping malls around the country are, with big box retail going out of business. In fact, in 2007, they had 98% occupancy. Those were the glory days, right? In 2022, when we bought the mall in March of 2022, it had 18% occupancy. The Macy's, the Dillard's, the Sears, the JCPenney's all shut down and went out of business. And so we came in, we were able to buy it at a very low cost basis. And I'll tell you, 2 things usually when you look at these shopping mall acquisitions. Number one is the amount of owners involved. Typically, and I'll give you guys a reference of West Oaks Mall, right? So the problem with West Oaks Mall is that, this land is owned by somebody, but the Dillard's next door is owned by somebody else. So oftentimes in these types of developments, you're negotiating between 8 or 9 different parties to be able to acquire the whole site. In this instance, we negotiated between 3 different entities: the former Macy's, the former Sears, which, let me tell you, they're perhaps the worst people to work with. You would think that they would be thanking us for taking real estate off of their plate, but that's pretty much all they have these days, right? Sears isn't really very much in business, so they like to play spoilers to these types of real estate transactions. But we negotiated between the Macy's, Sears, and a Chinese company that had acquired the mall back in 2011. And we took ownership of all 75 acres. And here it is, the entire shopping mall, you can see. And so you can see there's 275 right here on the left. And I-275 basically is, a major freeway. 230,000 cars drive by that every single day. And we have direct visibility from that, right? And you can see here, and I think so this is 275. This was the former Macy's. This was the former Dillard's. All this was the former Sears. And then this was the former JCPenney's, right? Now we have these tenants at the bottom here. We have Outback Steakhouse, Chipotle, Men's Warehouse. They're currently in business and they're paying us rent. You can see there's 2 parking structures. And ladies and gentlemen, this is the reason why we really like this investment, is because of these parking structures. I just mentioned to you, we're building a parking structure in Dallas, which is costing us about $20,000 per parking spot. Okay, just think about it that way, $20,000 per parking spot. So you can see we have one structure here that has 560 spaces, And then we have one structure here that has 2,860 spaces. So between the two, there's over 3,300 spaces. And then we have, totaling all the surface parking, there's over 7,000 parking spaces. So we basically came in, we acquired this, we put all of it together, and now we're going through and doing a mixed use redevelopment there. And with our mixed use development, of course, has a heavy emphasis on multifamily. We've been entitled for up to 2,600 multifamily units. So as you can imagine, that's enormous, but something that we intend on doing over the next 10 years, over 5 different phases, right? And you can see what we're trying to do is something like this. And what we're incorporating is, of course, number one, when I say mixed use development, of course, there's a lot of residential. So you can see in this first phase, there's about 700 units, but total we see, as the phases complete, depending on absorption in the market, we would continue with future phases. And then, of course, you see the green area. Now, this is something that we've really implemented here because ultimately we think the prototype of what these shopping malls are going to evolve to are these lifestyle centers, right? The place that you want to take your family to on a Sunday afternoon. And here you can see we've really added this area in order to activate this public. And you can see we've incorporated a stage for public events, splash park, something to really draw the public here. And I can tell you nothing like this exists currently in the Cincinnati area, right? And so you can see there's a hotel. So first and foremost, our idea is how do we monetize parking? So you can see that we've done that here by bringing a hotel and a small multifamily that would be attached here. And also in another variation of the site plan, we have a senior living component. So all 3 of those are basically attached to this parking structure, and they're basically, serving as parking for this. Our large parking structure would support most of the multifamily here, so most of the units would be here. And then basically all of this would be at the bottom, retail, right? So it's retail, multifamily essentially over retail. Of course, all of this has been impacted by Kroger's. And as you may know, Kroger's the country's largest grocery retailer, currently going through an acquisition of Albertsons. We've been in touch with them since last October. They're headquartered out of Cincinnati, so this project is near and dear to their heart. So we are, currently talking to them about doing a ground lease, right? So ultimately, to wrap it up here, the idea that there's 2 reasons why we got into this project. Number one is a very low cost basis, and we were able to buy all of this 75 acres, assemble it together with the existing infrastructure for $37 million. And then the second reason we got into it is because of the public funding component. And that is, ladies and gentlemen, that the city knew from the moment we stepped in Cincinnati, it was clear to us that the city was desperate for developers such as ourselves to come in and repurpose the shopping mall. Otherwise, it was just sitting there empty. So they offered us public funding in the form of what is known as tax increment financing to come in and repurpose this mall. So currently, we're working through those components. We're working through a much more updated site plan as this, and we're finalizing our structure here. And I'll be very honest with you. One of the challenges in today's market is debt, right? And George is, of course, going to go through that here in a little bit. But today, the rising interest rates don't necessarily have an impact on the business plan in terms of the short-term impact. The long-term impact is that what it's doing is it's freezing credit, right? Freezing money that's sitting on the sidelines waiting for something to happen. We believe that as indicators go for where interest rates will start lowering, a lot of that money is going to be deployed back into the market, right? But even during these tough times, we've been able to persevere, and we found our construction lender, and we're currently working towards completing our construction loan and working towards the next milestone of this project. And as you can imagine, we are the master developers. We're partnering with co-development partners to take on different components of this project. So our job was to acquire it, get all of the approvals, and then to do the horizontal infrastructure, redo the streets, the sewers, the lighting, and then we sell it off to partners that will come in and do the vertical development. So this of course represents our mixed use development side of our business. And the final thing I'll go through here with you is a case study of how these projects typically work. So as I promised you earlier before, mentioning, our investments in the NRG area. So at one point we owned about 1,312 units, right? That were made up between 4 different assets. So 2 of those assets are the Morgan and the Wilcox, once again, neighboring each other, totaling 624 units. We bought in at a basis of $87,000 per unit. So if you just did the quick math there, 87,000 times 624 is about a $53 million acquisition. As we're getting, and you'll see the location here, as you exit off of Kirby, you come straight down, and very first light is Westridge. You make a left, and again, we own that asset, we own that asset, we own these assets at some point. And honestly, ladies and gentlemen, our goal was to do what is known as a covered land play. If you're familiar with that term, basically you cash flow these assets, and as you're cash flowing them, you come up with a development to tear them down and redo them, because everyone understands the highest and best use for this land right across the street within walking distance of NRG is not Class C apartment complexes. So once again, you have the sprawling Texas Medical Center, and the numbers continue to look very attractive there, with jobs being added, and of course, as a result, all of them need a place to live. So once again, we bought these assets for $87,000 a unit. We were about $800,000 into our $2.8 million renovation budget, and we were approached by a buyer. And they came in and they offered us $125,000 per unit, or a $75 million exit. And ladies and gentlemen, that produced a 73% IRR for our investor who were doing the transaction. It was only a 1-year hold period, unfortunately. And I say unfortunately because it does apply to, of course, short-term income gain. And so, but we were able to provide our investors a 1.7 equity multiple, and then we use that to 1031 into our next transaction. So with that being said, I'd like to talk just for a moment in terms of what we're focused on here at Markets-Based Capital. So first and foremost, reducing our capital expenses, right? So understanding how we can implement operational efficiencies across the board, because ladies and gentlemen, there's not a lot of transactions that are happening these days, right? There's not a lot of acquisition or sales considering where the market is. So it's really on us to look internally in order to be able to maximize our operations. Of course, improving our investor reporting. This is something that's always on top of the list for us. But the key performance indicators that we're tracking, the timing of getting this out. Of course, this goes with it, K1s. I know that there's some in here that were frustrated with our delivery or the timing of delivery of K1s, but I'll tell you, that's working through the finances of property management, of CPAs, and sometimes you're relying on third parties. Part of us bringing that in-house is in order to streamline these processes and make it simpler for you, not only you to invest with us, but also for you to receive your documents as well as your quarterly reports. And of course, we continue to look at 1031 exchange opportunities that are out there, and that's what we were focused on. We essentially acquired out of a 1031, and our recent acquisition was 736 units that we acquired in North Houston. So as we look forward, we continue. This is what we do, ladies and gentlemen. Our jobs are for you guys to look to us when it comes to real estate. And so we have an entire team that's dedicated to this, working around the clock on a variety of projects, whether it's implementing our value add business strategy or building our ground up developments. Ultimately, we appreciate your trust in us, right? Because all of this success is attributed to you guys. And I said it earlier that it's fun in a excellent real estate market where it was the last 10 years. You could literally throw a rock and hit a good real estate investment, right? Here we are today where we're in a more challenging environment. And I want you guys to know that, you've put your trust in a team that's dedicated to delivering for you. So with that being said, I'd like to turn it over to our next speaker. And not only is he head of investor relations at Markets-Based Capital, he's also a chartered certified accountant, so CFA, and he is also part of the George Murphy Band. So ladies and gentlemen, please welcome Mr. George Murphy.
Thank you, Sohail. He crushed it. That's going to be a hard act to follow. I am a chartered financial analyst. Do not come to me with tax questions, please. Can everybody hear me in the back? Yeah. Thank you all for coming here. There's a lot of other things you could be doing on a Tuesday night. My favorite thing to do on a Tuesday night is be home. So I really appreciate it. And thank you to Sohail for giving me the green light on this. This is the first step in our seminar series. We plan to host these events quarterly where we're providing up-to-date market information on what's going on in this space. As we get better at it, we bring the right clicker to the thing and we figure out our, Evite process. the eventual goal will be to bring this on the road to the other cities in Texas, to bring more people into the market space capital family. So I'm going to be talking about some of the things going on in the market right now, discussing some of the headwinds that are impacting the space from a broad kind of macro level, and then also hopefully reminding some of you that you don't buy an apartment complex because interest rates are at 3.5%. You know, that's not why we have a business. We have a business because there's a need for homes, for housing. And when there's a need, somebody can step in and provide that service. So that's what we do. We'll talk about some of the operating expenses that Sohail mentioned. These are some of the headwinds facing us: changes in rent growth, delinquency, bank exposure to the space, and then some of the good things as well. You know, this is a fragmented industry. Housing costs are astronomically high right now, and we have just this super influx of tailwinds in terms of demographics behind us here in the Texas Triangle, and specifically Houston. Elephant in the room, interest rates. Over the last, what's it now, 18 months, we've seen I think the quickest interest rate hike in history. This is impacting every aspect, every multifamily, every commercial developer, every real estate owner, unless you have all cash. Yeah, well, sure, even if you have all cash in your deal, you're still being impacted, because if I am going to go buy a property and my cost of capital is more expensive, I can't offer you as much money as I could a year ago. If I'm going to redevelop a property and I'm pulling out money to fix up units or stuff like that, I'm paying interest on that loan. That's money that's eating into my operating expenses. And the same thing, if I'm looking to buy a property, credit lending standards have tightened, the bank's lending less money, and now it's more expensive. That is contributing to not a freeze in sales volume, but a drastic decline in the amount of properties that are changing hands. And I want to point something out here for later. You have, I think it was the taper tantrum, right? Where interest rates started going up in like 2018 and then came back, or maybe that was before that. Anyway, the prime rate, I should have explained, is the interest rate that multifamily commercial real estate operators borrow at. And it's based loosely on the federal funds rate, federal funds rate plus the spread. And this rate and the federal funds rate started going up in 2018 before coming down for COVID. Then you had this 2-year stretch where the federal funds rate was pegged at 0, the prime rate was at like 3.5, and it created one of the largest, refinancing waves that this country has ever seen. If you know any title brokers, it was impossible to get a hold of them, for 2 years. Like, they were so busy. People were refinancing their houses, and I'll come back and touch on that a little bit later. The second thing, so collect your rents, you pay your mortgage, and perhaps the next biggest expense is going to be your property insurance. So this is looking at the year-over-year change in multifamily property insurance costs at the end of Q1 2023. Unfortunately, Texas is the second bar on the left. We had a 45%, Houston, we had a 45% increase in the cost of property insurance over the last year. The national average, 22, 25, 26% increase. So all owners, all operators are feeling this, some more so than others. And we, unfortunately, in Houston are one of those. And then Sohail touched on, yes, this is a hedge against inflation. Typically, you're able to pass along increased expenses to your tenants. The line in orange is year-over-year changes in rent. The line in green is the change in U.S. wage growth on a rolling 3-month scale. It's great when, yes, you're able, if rent's increasing, from 2016, right around 3% a year, that's great. You're able to pass the effects of inflation on to your tenants. You have COVID hit, and all of a sudden rent increases by 16% year over year on a national average. That's wonderful. You're able to pass on a lot of stuff to your tenants when rents are going up by that much. But as you can see, there's been a correction here where rent growth has declined. In some markets, it's negative. The national average is just positive. And combined with, this whatever, 2 to 3x multiple on interest rates, property insurance costs, not stabilizing rents is a good thing, but we're not able to pass all of those expenses on the way that we usually do. I do want to point out on this slide, this is a totally separate point, but this green line, the pace of wage growth in the United States is above the change in rental income, which is a good thing for our economy. I know there's a lot of, hey, are we going to soft landing, hard landing, whatever? And there's a lot of different indicators out there, but this is one of the positive ones. If people have more money to spend at the end of the month, we're a consumer-driven economy. It naturally makes sense that if you have more money in your pocket, you're going to spend more money. You're going to take your kids out. You're going to maybe move up in class from a C to a B minus or whatever the case is. So this is a very positive indicator for the economy. Banks, Sohail touched on it as well. Banks are, specifically community regional banks, are heavily exposed to commercial real estate. And this is looking at the change in exposure to commercial real estate loans since 2015. The dark red shaded area is regional and local banks. The light pink area is large banks, the JP Morgan and stuff like that. And you can see regional and local banks added over $1 trillion of exposure to this space in the last 8 years. Large banks don't have to add as much. They have investment arms. They're able to make money in other ways. But community and regional banks, especially over the last decade, made a lot of money on these types of loans, where your 30-year mortgage was 3.5%. Compare that with a commercial loan where you're paying 5 to 5.5 on prime. You have this huge upfront pop when closing costs to the bank. They typically refinance in 2 to 7 years. This has been a huge moneymaker for regional banks. And then in the last 18 months, you've had 3, I guess 1 go under and 2 others were acquired. Sent a jolt out through the regional bank community. Bob, I'm sure you can educate people on this later. People who bank with regional banks are scared that their money is going to get caught up in the next failure. So they start moving their money to JP Morgan, Bank of America. Regional banks' deposit to loan ratios get out of whack, and all of a sudden they can't or won't lend anymore. It is almost, compared to where it was 2 years ago, the difficulty in securing financing right now, again, when you have a 2 to 7 year, you have to basically give the money back to the bank in 2 to 7 years, which typically involves either selling it or bringing in some other form of financing. And when that other form of financing isn't available, and here, let me just jump forward too. When you didn't put it in there. Essentially, these high interest rates have froze the market. We're at the lowest level of sales volume in this city since 2018, 2019, somewhere in there. And it's directly attributable to interest rates and tightening credit standards. And just, there's another theme I'll touch on as well. This is the multifamily loans that are in serious delinquency or foreclosure since 2012. So you have that peak in 2012 coming out of the great financial crisis, and you can see it's starting to trend upward again here. I'll come back to this, but this is going to be a headline grabber. People are going to see something like this. They're going to write the editor's going to put a click, and that's going to be the thing that you see, the headline. You're going to just scroll past it on your Google News. And you're like, oh, wow, multifamily delinquencies are going up. I'm not going to invest there. And then you're not going to read the article. And that's how people get their news today. What that headline would fail to mention is that even today, we're still only at 0.23%, less than 0.25% of multifamily loans in delinquency. It's 23 basis points for you finance guys. So look, they are trending upward. It is not the end of the world, and not something. I won't add a third thing there. So there is some good news. And I said it before, you don't buy real estate because you have a 3.5% interest rate and it's, hey, this is a good deal. You buy it because it's tax advantaged. You buy it because the submarket that it's in is growing and the economy is strong and people need a place to live and you are solving for a need. If you look at today, the blue line is the Case-Shiller National Home Price Index. The red line is the average rate on a 30-year mortgage. Now, I'm sure there's a lot smarter people than me who make financial policy. I don't know if this was intended or not, but as the Fed started raising interest rates here to tackle inflation, it has not had the impact on residential home prices that maybe they thought it would or maybe they didn't. I don't know. But remember earlier before when I referenced that 2-year stretch where everybody got to refinance their house? That's an issue because the people who refinanced or bought in that 2-year stretch are just sitting in their homes going, why would I sell my home right now when I'm at a 3.5% loan, when I can go buy a more expensive house, get less house, and then pay more on my mortgage? It's just not going to happen. Unfortunately, this contributes to inflation as home prices remain elevated. That is a measure of inflation, which unfortunately may lead to more rises in interest rates. I don't know. How do you get out of that? There's smarter people than me to figure out how to get out of that circle. But this is a positive sign for renting. It's harder than ever, harder than it's ever been to get into a house, to get out of an apartment and into a house. Excuse me. This is more data backing that point up. There's a lot of numbers up here. This is from Freddie Mac. They looked at the change in the cost of home ownership since the start of the pandemic versus the change in the cost of renting. And just to, I don't need to go through it all, but cumulatively, there's been an 84.8% increase in the cost of home ownership in the last 3 years. There's been a 19.3% increase in the cost of renting since the start of the pandemic. So again, all these numbers are just showing you that renting is still more economically feasible than buying a house. Demographics, this straight line, I'm sure many of you would love that to be your investment portfolio. That is the state population of Texas. Since I've been alive in 1988, the population has doubled from just under 16 million. We're now up over 30, right at 30. And the Texas Demographic Center projects the state's population to go to 34 million by 2034. So in the next decade, this growth is expected to continue. Those people, when they come, when they're born, most of them live in the Texas Triangle. Dallas, Houston, San Antonio, and Austin. And this is really, I had to write these up there. You won't see a lot of words in my presentation, but I wanted to make sure that I got all these down because this is really cool. I didn't know this stuff about the Texas Triangle. We are the 8th largest economy in the world. We are larger than Canada. We are larger than Italy and a bunch of other countries, obviously. And we're the 4th largest metro region by population in the United States, behind Southern California, the Great Lakes region, and New England. Unlike the Great Lakes and New England, we are all in one state. All the tax revenue, all the economic output, all that stuff is confined to one state. And we are actually our population is projected to grow past Southern California by the early 2030s as well. So we'll catch them. Between 2010 and 2021, the economy of Texas increased 39%. That's 1.5 times the national average. This year in 2023, our GDP is expected to be $2.35 trillion, going faster than California for 23 consecutive years. Texas is responsible for 1/4 of all of the United States exports. We've had 140 major companies relocate here since the beginning of the pandemic, and we are responsible for more than 35% of all the jobs created in this country since the beginning of the pandemic. That's just this triangle. Bob, I'm sure you're going to love this. Let me get back to it. I referenced earlier just reading headlines. This is from today. I just Googled multifamily in Texas, and these are the top 3 things that popped up. What to make of the latest Texas rent data? That's not bad. Apartment rents on the verge of declining due to massive supply. Rents finally cooling. See how much prices have changed. There's this narrative going on that these macro headwinds, rising interest rates, increasing property insurance, that they affect all states, all submarkets the same. And it's not true. Like if you, the types of investments that we sponsor are called direct private placements. There's an LLC with 1 or 2 properties inside of it. You as the investor come in and you buy shares of that LLC. If you go buy a REIT, you're getting exposure to real estate that way, but there's typically 60 to 100 different properties in there. And aside from not getting the depreciation component of it, not getting the 1031 ability of it all, you're also not getting able to get super specific on your real estate allocation. Like what's going on right now in Houston is totally different than what's going on in Washington, D.C. or in San Diego. And just to make a broad sweeping statement that all I'm going to wait out the market is just, it's ignorant. Yeah. And my job at Market Space Capital, Director of Investor Relations, I talk to you every day. I call people, I take people to lunch and dinner. It's my job to get more eyeballs on this company and on our investments. And the most common objection I hear is I'm not comfortable with the market. I'm going to wait it out. Well, what are you talking about? Are you just reading the headlines? Anyway, I'm off on a little bit of a rant right now, but fragmentation is one of the best reasons to invest in real estate. And then doing it in a direct private placement vehicle where you're able to really understand what's going on in the submarket that you're investing in is a great way to do it. So let's talk about Houston. That's where we're at. A lot of numbers, a lot of graphs. If we look at the graph over on the far left, year-over-year growth in effective rent. You'll see this channel. How do you use the pointer here? There we go. So that's 1% right there, that line. 10%, that line. I can't really see. So you'll see since this is since 2000, our rent growth has been, 5 to -2 to 3, kind of bouncing in that same channel. Then we had this explosion in COVID. And yes, rents have fallen. How do we go back? Where's the headlines? Rent is falling. Rents are finally cooling, right? Like the headline's not going to tell you that rent is falling, but it is returning to a sustainable and profitable trend where it's growing between 1 to 3% a year. That is a profitable system that has worked in this city for a long time. And you can see this is effective rent per unit since 2000. The blue line is Class A properties. The orange line is just the entire market. It's a steady market upward. It's a steady march upwards. Again, with this little hiccup here with COVID. But if you zoom out, the broader term trend is, again, sustainable, profitable, and it's what we like to see. If we look at year-over-year growth, I think I already did this one. Is this Dallas? Okay, I asked him to take this one out. Anybody want to talk about Dallas? Same sort of story. It's a little bit more hectic here with COVID, a little bit more volatile of a market where during COVID, rent shot up like 15%, 14 to 15% here. You see this effective rent per unit. You had this huge spike and then kind of flattened since. Another big thing to look at is vacancy. Look, if you're looking at a deal and hey, talked to a guy yesterday, he's looking at a deal in Delaware, right? These are some of the statistics that are going to help you make an informed decision. What's the year-over-year rent growth in the market? What's the effective rent per unit? What's the vacancy rate in the market? What's the longer-term trend? Vacancy right now in Houston is 9.35%, 9.45% overall. But is that in line with the broader trend of the market? And I would argue that yes, it is. We're right here, 10%. 20 years ago we were at 7%, and it's just kind of bounced around between there. This Class A blue line here I'm sure this is probably attributable to the decline in oil prices, where people, there's a little bit higher vacancy in Class A here in Houston, but nothing out of the ordinary. And then I think this is a great. And I know that I'm the one between you guys and dinner, so this will be my last slide, I promise. This is a great visualization of it. This looks at all the submarkets in the country, and submarkets that brought on more than 10% of their total inventory in a given year they're on average, rents are declining three and change percent year over year. Submarkets like Houston brings on average about 1% of their inventory. So you take all the apartments, all the doors in the city, and then in a given year, how many new doors are added? It's about 1% here in Houston. It's been that way for about 20 years. The slide is missing, but you look at Houston, if you brought on submarkets with less than 2.5% inventory growth, still are maintaining positive year over year rent growth. Supply and demand, right? If you bring on 10% more units into a given market, it's not going to be able to, the demand just won't be there. You're not going to be able to charge the same thing. So I think that, do Dallas. Before I open it up for Q&A, and if there is something that I can't answer, I will get Sohail back up here. Thank you. First of all, again, this is our first one of these things. There are folders on the table. We're still working out a system here. I'm going to be calling all you guys tomorrow, asking for your feedback. What can we do better? What did you like? Everything from, what I'm wearing to the way I comb my hair. Please let me have it. There's some information in there about our firm. There's also a due diligence questionnaire. If you would like to learn more about the investments that we sponsor, have us look at look, we are real estate advisors who happen to sponsor products in real estate. So if you have a deal that you're looking at, call us. We have analysts. We're happy to have them look at them. If you would like to speak with us about your own investment portfolio or adding money to something, we're happy to do that as well. So I know that this is a friends and family event. I'm not going to get in the way of relationships. If you would like to do that, please fill out that due diligence questionnaire. Give us a little bit of information about who you are, your investment experience, so that we can have that to call on tomorrow. And thank you very much. Are there any questions in the audience?
Do you offer only like a particular location or particular investment with a particular result, or do you offer all 4 or 5 whatever investment you have combined in one?
The question is, do we offer specific investment types, specific submarkets on a standalone basis, or do we offer everything together? Do we have a fund, essentially? Great question. Thank you, Yogi. We do not have a fund at this moment that offers, diversification, right, where you're able to get different submarkets and apartment types, and we don't do that. Our deals are, like I mentioned earlier, an LLC acquires the property, shares are created inside of that LLC that investors come in and purchase. Once those shares are all purchased, then the investment closes, and then the next deal will, whenever that presents itself, we'll open that up, and the same sort of process gets put in motion. Does that answer your question? Yeah.
What is the minimum?
The minimum investment is $25,000 for a ground-up development and $50,000 for $25,000 for a value-add development and $50,000 for a value-add. I keep saying it wrong. $50,000 for a ground-up development. Yeah, sorry, I butchered that. Anybody else?
What's the next show for George Murphy Band?
The George Murphy Band. No, I'm not pushing that up. Yeah. Next Friday, October 20th, Continental Club. We're going at 8:15. That's my dad right there. That's George Murphy Jr. We are half of the George Murphy Band, and we rock out. Thank you all.